Hello! We're going to talk about Microsoft in this video because it has dropped significantly from its highs and yet the company is doing tremendously well. So let's examine the financials first, actually by taking a look at the quarter, the latest quarter, as the stock actually dropped 7% on slowing cloud growth, light margin guidance. Some minor discrepancies here in terms of what the street was expecting actually led to the company going down significantly. And as you'll see, they had earnings percent that was actually more than what was expected, and revenue that was also more than what was expected. Now, with respect to guidance, Microsoft called for 80.65 billion to 81.75, and the middle range was 81.2, meeting the consensus, as you'll see, of about the same. The company's forecast for quarterly Azure cloud growth was 37 to 38%, and the consensus was also 37.1. So generally speaking, you will see here that all of the metrics for Microsoft have increased. Like revenue from Azure and other services grew 39%. They reported about 10 billion in other income, compared with other expense of 2.29 billion at the quarter a year ago, the same quarter. And the backlog is really good, but the disclosure that OpenAI is 45% of their backlog, it goes back to the situation where can OpenAI achieve these financial goals. So generally speaking, the company in terms of their operations is doing really well, yet investors have been spooked a little bit because they are spending a ton of money, especially in capital expenditures here, and they're putting a lot of their ambitions on AI and also OpenAI, of course. Now, if we take a look at the stock itself, you will see that in the past, let's say 6 months here, you can kind of see that the company's stock has been going pretty much a little bit upwards and then downwards a little bit, sideways quite a lot, and also now down quite significantly, reaching about $400 right now, which is 100 less than what it was 6 months ago. And I'm getting interested. I'm getting really interested because the P ratio of the company is sitting at 25, and it's an X because 25 is actually our threshold here. Actually 20 is what I have, but even 25 for a company of this sort could mean that it's a good opportunity. Now, outstanding shares of the company have been about the same, as you'll see. The price to free cash flow a little bit elevated, but there is a reason for this, is the company actually spending a ton in capital expenditures, and you will see also that it's still getting better as the stock price has been going down, again sparkling my interest. And then the revenue goes up, net income, all of the financial metrics for Microsoft, as you'll see, even the free cash flow amid spending a ton of it, is still very solid. So I love what I see here with again fantastic margins here. So the company, in terms of the numbers, even the return on assets, equity, all of these returns here, almost no debt at all for the company. Everything looks fantastic here. Now, if we take a look at the AI deep dive, you will see that there is some concern about the data center tab, for instance, as they are not only building their own data centers, but also leasing. As you'll see here, they have lease commitments here that totaling 155 billion, which is crazy, absolutely crazy. Myself, I actually love that stuff because I think AI is going to be huge in the future. So I love that they are actually investing in this. Some people, though, may be a little bit hesitant. Now, obviously, the IRS would be wanting its tax, and this is a story here that is identified. Cloud is booming, but AI is eating the profits, understandably so. Cloud revenue has jumped quite significantly here. Gross margins fell a little bit, still to a high value, because the specialized chips and power needed for AI are far more expensive than traditional setups. And also you will see that they are spending a lot to make 80 here, spending 50 to make 80. The capex treadmill, known thing, you have to spend, especially in this kind of era. These kinds of data centers, these kind of capital expenditures cost a ton. And again, in my opinion, this is a growth that makes a ton of sense. So I love what I see. Well, the one bad thing here is the Xbox frustration, as revenue is down 9% as hardware slumps. So Xbox is not doing really well, so there's a segment drag here, as you'll see. It's probably one of the few segments that are actually not doing really great here for Microsoft. But I don't think it's the big thing, frankly. So actually, I think it's a much more minor one compared to everything else that is happening. So you see, it's the ultimate AI growth story, and for that growth is a 155 billion pipeline of future lease obligations, what we saw, and some taxes here. So yeah, looking solid in my opinion. Now the key stories swimming in cash, and this is what I love to see when I buy a company. Of course, bills are piling up, understandably so, but they have a ton of money. Cloud is booming, what we talked about, OpenAI, and a nice bonus that complicates the math. Yeah, again, understandably so. Some paper gain as well, and this is from investments and stuff. Rent is basically more debt. The leases that we talked about. So this is the story, the ARS. So this is the story about the company currently. This is what's going on with them. Now, I want to also like to take a look at the income statement, and the balance sheet also, and the cash flow is interesting. But the income statement can actually tell us what the company has been doing through the years. And if you start at 2016, they used to have 85 billion, and now they're sitting at 305 in terms of revenue. And if you take it at the net income, it used to be 16, and now it's 120. So we're talking about incredible growth here through like 10 years. Absolutely incredible growth. And I like to see that. And it doesn't seem to be slowing down. And if we take a look at the cash flow, you can kind of see that the company is having a little bit of a limited free cash flow than what they could have, mainly because of the capital expenditures. And you will see that they have grown at a tremendous pace, 10x here. It used to be 8 billion, and now it's 83 billion, almost 10x. Insane, isn't it? That actually affects the free cash flow, so it's actually lower than what it would be here because it's minus capital expenditures, right? This is how we derive it. So a lot of the income that the company generates goes back to the company in terms of investing. And again, it's something that I like because this is how you grow a company that is this size. How can you grow something if you don't spend a ton of money on it in things that make sense? I didn't like it when Meta was doing it for the metaverse, but I like it here because I think there is a lot of value going hard into AI here. So I like what I see here from Microsoft, but I want to also take a look at the discounted cash flow model here because we can kind of evaluate the cash flows that the company generates. Now notice, and the tool tells you, which is fantastic, I don't think you will find it in any other tool, something of this sort here, and it's dynamic, calculated for every company. You'll see high capital intensity. So what does that mean? This means that the company is reinvesting a lot in capital expenditures. So they're spending a ton. And when you do that, the DCF model is going to look suppressed. So it will make it appear conservative because a lot of the free cash flows are going to be extracted already. And so this actually tells you about it. The tool actually automatically tells you about any company when this happens. So you can actually calculate better what you expect from it to happen. And by the way, you can visit stockainsights.com and register and join basically for free and examine the tool. I think you're going to love it, and you can do everything I'm doing here. There's a ton of things to see, plus also an API that exposes everything in an API format for your own models. It's pretty awesome. Now, if we take it down here, you will see that using the Stock AI Insights Lucky 13 model, you have the pre-populated scenarios. And notice I have added, this is a new feature that I added recently, because I wanted to account for this situation that I talked about now, the cases where the companies are spending a lot. So I have sort of like an owner earnings mode, which adds back capital expenditures to show the power of the company's cash flows before any capital expenditures are actually going out. So before this actually free cash flow is delegated to be used in capital expenditures. So what would happen if the company actually wasn't investing pretty much in capital expenditures is what this tells you, and it gives us more of a discounted cash flow model that makes more sense for understanding the intrinsic value of the company. Because if you don't do that, and I calculate the intrinsic value now, asking for 13% return, which we typically ask for, this is going to appear like the company is very overvalued, and that's not the case. Again, because remember, the company is very capital intense here. And so now you're looking at $200, which appears like 44% overvalued, even with the highest growth here, highest margins, which are for the most part typical for the company, but yeah. And it appears overvalued. But if you check this box, now it adjusts the margins to account for the capital expenditures going out. And so now if we calculate explicitly again, the intrinsic value, this is going to be higher expectedly because now we're not actually extracting the cash flows going to capex. And so now we're closer, much closer to the current market price. And remember, this is not the amount, this is not the price to pay for the company as a total. It's about its cash flows. And we're also asking for 13% return. So this is super reasonable here. And it's actually even cheap if you ask me. So we are sitting at a very nice territory here for Microsoft. Because remember, this is the required return 13% for an investor who could even ask for 11%, especially thinking that this is a company like Microsoft, which is a very high value company. It's a giant, really. And so getting a price that gives you a required return of 11%, it's very worthwhile. And again, a company is not only its cash flows, it's also about its growth, the potential for the future. There's a ton of things. And this is not just a company that is like a supermarket that's giving you the cash flows back in dividends, for instance, right? So you have to account for all that stuff. So now we're sitting at 470 here. And if we go required return of 8% here, now this is going to be much lower, and this is closer to the WACC, the weighted average cost of capital, pretty much, that is being used in acquisitions for the most part. And I have actually a full section explaining this. I'm gonna show it when I close the video. But now you will notice probably what you'll see in most DCF models around there that you use different tools. But the difference with our tool is that it tells you exactly the reasons, and it shows you exactly what it is using, and you can understand exactly what is going on here. And also, if I take it to the Investors Academy here and I type WACC, I actually have created a full-blown page that explains exactly what the WACC, and I have made even a video about the coffee shop analogy. You can find it in my channel if you're interested. I think this will actually explain in a very easy way what the WACC is. But the point here is you have to understand the distinction here, the key insight. So when an analyst says that the fair value is 80, they are talking about, for instance, the WACC here, and we say that it's 45. We can both be correct because there is different reasoning. So the WACC is actually about the cost of the capital for a company, but in our case, it's actually how much money we can extract out of the company. So it's a different case. And so usually you see something like 13% as a required return for an investor, while you could see 9 to 10% or even 8% for a company, because this is calculating what an analyst thinks the company is worth in terms of the cost of equity of the company and the cost of debt of the company. It's a different story, which you have to understand, and the tool accommodates for both. But what I see here from Microsoft, I really like. And would I actually buy the company today? Actually, I would. I think it's a buy, even right now. I think it's very strong. And obviously, everybody loves to get companies where they are becoming cheaper. And I could even see this being cheaper because there is, this sentiment right now. But especially if there was to be even like a mini crash or something where it goes maybe even 300, it's plausible, of course. Then it would be a fantastic situation here. But even right now, buying and holding for like 10 years, I think this is a fantastic opportunity, frankly. And yeah, definitely recommend it. What do you think about Microsoft yourselves? Have you seen it in such a valuation before? Do you think it's still expensive, cheap? Tell me what your opinion is. Leave a comment below. I'd love to hear it. And thank you for watching. Bye.